I'm Michael Fox, and this is the Prospector News Podcast. And we are live on location at the Mines and Money event in Miami, Florida, where it is sunny and nice compared to back home, where it is kind of snowy these days. I am sitting across from Mike McGlone, who is the senior commodity strategist with Bloomberg Intelligence. We've been trying to get Mike on the podcast for quite a while now, and we finally managed to do it. Welcome, Mike.
Thank you, Michael. It's good to be back. It's good to see you in sunny Miami. I actually have moved here a couple of years ago from the frigid Northeast.
Yes, I think New York's going to get the same weather I'm supposed to go home to tomorrow. So I'm part of me is kind of hoping that maybe I get stranded here for an extra day, but we'll see how that all plays out. So let's take a look at the commodities in 2024. Gold seems spent most of 2023 in that box between about 1850 and 2000, and then took a run in December, broke out of the box. It seems to be setting a new floor in at 2000,
Yeah.
but it seems to be trapped in a new box. Is that the way you see it?
It's just a matter of time it goes to 3,000, and it's just a matter of catalysts, the way I see it. And it's building support around 2,000. We've had one little dip this year below 2,000, fully expected. At the same time, gold dipped below 2,000. We're seeing record highs in U.S. stock market, and we've seen U.S. T-bills running at 5%. I like to say is with the stock market on a tear and T-bills at 5%, why buy gold? Obviously, I'm rhetorical, but I think that's what's happening. You're definitely seeing that with ETF outflows. Total holdings of ETFs, total known ETFs in gold are about the same. It's 83 million ounces, about the same as the year 2000. That's 4 years ago. But what's holding up gold is the macroeconomic environment. It's so significant. Two words: unlimited friendship between President Xi of China and President Putin of Russia. That was a world order shift, and the largest buyer in the world now of gold is China. The word that the World Gold Council used for China buying gold is colossal. And so I look at gold. It's the only major commodity I see still advancing this year. And I had made that call last year, and I don't see what changes it, Michael. And I think the key thing that might accelerate it is just a little bit of back and fill in the U.S. stock market, because that's everything right now. It's just this overwhelming speculative frenzy that's sucking everything in, and it's taking Fed easing out of the market, which is a bit of pressure factor on gold. But the rest of the commodities are under the auspices of the wrong part of the cycle, the high price cure. You can see that in virtually all commodities, and gold is a major commodity that doesn't have that issue. So I think it's a matter of time. I think if gold does go down, it's because that U.S. stock market just keeps going up.
Yeah, I look at the stock market and I'm confused. Like the Fed keeps saying higher for longer, higher for longer, higher for longer. And the stock market says, hold our beer, we don't believe you.
I like the exact way you say it. So about 2 years ago, I was early, but I kept making the point that in commodities, when they rally at the velocity they did up to that peak in 2022 with Mr. Putin's invasion of Ukraine, they're their own worst enemies, and it's working out exactly as I expected. Also, a lot of that's based on some of the things I've learned from a great Canadian, Jeff Booth, who wrote the book The Price of Tomorrow, just about how advancing technology is rapidly happening so fast. So the way I see gold right now is the stock market, it is its own worst enemy, because every time you see that stock market going higher, all that easing that futures have priced in for the Fed to start easing goes away. And there is no reason at all for the Fed to hike rates as the stock market's in the middle of a speculative frenzy, which it clearly is. One or two stocks are driving it, but it's clearly a speculative frenzy. You're seeing that in things like cryptos, and with their core measure of inflation, their target, this is core CPI, PC deflator, running about double their target. Yes, inflation is declining, but this is a silly situation now, I think, in terms of the rally in the stock market. It's just, I like to say it was just like commodities were when they were their own worst enemy. They call it the high price cure. That's what's happening in the stock market right now. It's the high price cure. It's taking Fed out of the picture. And the longer the Fed refrains from easing, the longer as most central banks refrain from easing, the longer we're going to have that cycle where we have to have the inevitable effects of tightening.
Yeah, I look at it and I get, as the bubble keeps getting bigger in the stock market, I keep getting more and more worried that something's going to puncture that bubble, and it's going to be a violent retreat rather than systematic, slow aching downturn. And the longer this goes, the more I see that. Um, if the market turns, I guess that's what's going to be a catalyst to shoot gold through that 2100 upper barrier.
Maybe not initially. For those of us who were really overweight gold in the year 2000, because we saw it was coming, we saw that rally up to 1,000 and then dip down to around 700. I'm talking US dollars, obviously, when the stock market started collapsing. But this is a different case, right? The difference right now is the stock market's the most expensive ever versus GDP, most expensive ever versus other equities, the MSCI US, ex-US index, and things like that. And gold is, I love looking at things like 50-week moving averages. You look at that 50-week moving average gold, it's all an all-time high. It's just below 2,000, but it's clearly pointing upwards. And you look at 50-week moving averages, crude oil, copper, and all most other commodities, they're all heading downward. And you have to ask yourself what changes those trajectories. And I say, one key thing that could change that gold is if you have a little bit of détente, a little bit of pullback of Mr. Z's unlimited friendship with Mr. Putin. I mean, that's a key factor. The fact that the tilt in the second largest economy in the world is shifted towards the bad guys, Russia, North Korea, and Iran. And the whole world says, get me out. That was the largest demand pull for industrial metals, just imploding. I think it's a Great Depression kicking in China. So that's where I see gold's right in the middle. It's the best opportunity to keep going higher. And we have the largest central, the most significant, deepest pockets on the planet. The largest central bank of them was China, buying gold at a colossal pace, according to the World Gold Council. So to me, that's the underpinnings. And then I look at it is to really accelerate that trend is just a normal correction in U.S. stock markets. And I point out some little technical things. I traded S&P E-minis. I was at a hedge fund when they first started trading in 1997. And on a weekly chart, the S&P Future E-mini, the most liquid benchmark measure on the planet, has a gap in December when Mr. Powell did his pivot, which he said he's going to be easing, which I thought was going to go down in the world as one of the biggest mistakes because he helped goose this big speculative frenzy in equities. S&P E-minis has a gap down to about 4,600, which from current levels is about a 10% drop. We've never left the gap in that market without feeling it within a month or two, ever. Okay, so maybe this is the first time, but it's just signs of what mania. And that's why I look at gold's in the middle. I think astute investors are allocating to gold. The key thing I have to point out about gold is, I've been saying this for 5 years, is old analog digital appears a little bit naked without old analog appears a little bit naked without some of the digital Bitcoin in that space. And that's what's really happening. We have on one side of the coin, we have China pushing back on this new digital technology and cryptos and buying gold at a voracious pace. And we have the other side where we have the US, which will eventually do the right thing after exhausting all possibilities, Churchill said. It just approved gold Bitcoin ETFs. So that's the way I see it now in the world, bullish gold. But the way I see it is you got to have some digital gold, Bitcoin in that space, or you risk missing out.
I see. When I look at China, I get very concerned with the Evergrande situation. That is a great unraveling that we haven't seen since 2008. Do you see that unraveling orderly, or is that going to be a catalyst for contagion across Western banks who might be exposed?
It's already happened. We've seen it a little bit. Hong Kong, Shanghai, HSBC just pointed out they had some issues with property. It's trickled down. The second largest economy in the world is essentially mean reverting. Simplistically, if you study all the histories of emerging markets, they haven't really had their significant correction. And what better catalyst than what one person, I have to respect the whole Chinese people in the country, what one person did. I think history is going to look back at what Mr. Z did with unlimited friendship and say, let's use an American vernacular and say, dude, what were you thinking? Because what's happening now is in 2015, he shifted a lot of banking assets away from property, saying it was too speculative, and shifted it towards solar and EVs. And now what are we having? Significant deflationary forces in Chinese exports of not just EVs, but automobiles. Largest exporter on the planet now, which is crushing Germany and European economies. Solar's collapsing and the property's collapsing. So here's the thing I see what's happening in China. It's some combination of what I read in the book Atlas Shrugged by Ayn Rand, what happened when Japan and Soviet Union peaked about 30 years ago, but with much more severe situations. So a book I recently read was called The Price of Time. The author, a couple authors, I can't forget the name, but pointed out how the excesses of valuation in Chinese real estate was about 4 times GDP, or very similar to what Japan was at the peak around 1989, 1990. the stock market was very similar to the peak, the US peak in Japan at the same time. And it's all trickling down. So the key thing right now, in an industrial metal standpoint, you have to, and even from most commodities, you have to depend on significant fiscal and monetary stimulus in China just to support that market. You look at the Hong Kong or the Hang Seng Index. The Hang Seng Index is the most enduring representative of Chinese equities, is at the same level. It's the lowest level since the S&P 500 since 1975. I mean, we remember this, Michael. That's when Chairman Mao was in charge. We talked about this earlier. That's when President Nixon went over just to help a little bit detente against the Soviet Union. Well, what has China gone back to? Right back to the old bad guys. So to me, this is historic. We're going to write about it and read about it in the future. And there's nothing that stops it right now. So property is way overvalued, just reverting. Their biggest export customers, the US and Europe, they just one person just completely upset them with this war and unlimited friendship. US imports from Mexico now are just off the charts versus China. And it's not only political in the US on both ends of the aisle, but completely global, particularly in Europe, where they were the largest export customers for China. And Europe is like, GMTFO of China, get me the heck out. And for good reason, because of the war. So this is epic, historic. And from a commodity standpoint, it's nothing but bearish. From a global economic standpoint, it's nothing but bearish. And some kind of detente is needed. But where we sit right now, it's bad for copper, bad for industrial metals, good for gold.
Good for gold. So gold will probably go up as this continues to unravel.
Yeah, and it's exactly what the key question is. We should get tradable bounces in most commodities. First of all, let's start with the Hong Kong Hang Seng Index. I mean, it's so cheap versus it's tradable bounces overdue. And what the Chinese government's been doing lately is every single day you hear about new restrictions. Now you can't sell. Like, okay, well, hard to go down if you can't sell. I mean, can't short, get that, but it's then that's the macro. I don't know what stops it. And then the other side of the aisle is what I point out with the US equity market. It's an inordinate burden for the US stock market, has to keep going up, because I look at it like the book, Atlas Shrugged, like Atlas holding up the world. The whole world is completely dependent on that S&P 500 going up. If it just drops, say 4, 5, maybe 10% this year, the deflation we're seeing in commodities will trickle down. So I'll end with this fact. You look at the average of PPIs from the US, China, Japan, and Germany, the 4 horsemen of the global economy, it's running about -3%. Obviously, the deepest right now is Germany. Exports, GDP is about 50% of their economy. It's -3%. And at the same time, US Fed funds rate is 5.3%. That wideness, about 8%, Fed funds at 5.3%. PPI, producer price indices, which is a high beta measure, early measure of inflation, is the widest ever. Now, my database only goes back in Bloomberg to 1993, but those are just accidents waiting to happen. That's why I point out is that US stock market must go up, because if it doesn't, which I think at some point it will just revert a little bit, the deflationary dominoes for a typical deflationary recession, which is very, very logical. If you look at the histories of biggest liquidity pump in history that we just had up to the peak in 22, reversing is just kicking in. So I pointed this out too early a few years ago. The thing I was really wrong on so far is the US stock market, but now we're at that stage where it's so expensive and so rich and so driving so hard that everything is dependent on it not going down for us not to get that typical deflationary recession, which is already happening in China. It's happening. Japan is doing okay, but they have recession leanings there, recession leanings in Europe, recession leanings in Germany, and China is completely dependent. Okay, what's our next measure of stimulus just to support us?
When you speak of deflationary, I just wanted so that people are clear on it. Are you talking about asset deflation, or are you talking about consumer price deflation?
Everything. So the measure of the number one definition of deflation is just when prices go up too high and they mean revert. Best example in history, most recent comparable, is the 1920s. All assets just went up too much, most notably the stock market, and then reverted. And we had severe deflation until 1933, until the U.S. debased the currency against gold. FDR. Okay, boom, that ended everything. Boom, you're done. But you had to have an 80% correction in the stock market first. Now we have a situation with all the lessons of history. There was a book I read called Boom and Bust. All the lessons of liquidity that pump and then dump are really bad for asset prices. So the key thing that's really supporting inflation right now is this massive wealth effect you're getting in housing prices are still going up, the stock market's still going up, and we have, let's see, in 2023, the U.S. had nominal GDP growth of $1.6 trillion, and it took $2.5 trillion of deficit spending. I mean, good luck with that one. We know that's not a good sign. So massive deficit spending, still a bit of a wealth effect. And we see inflation numbers are starting to get sticky around 5%. That makes sense. The only way to really get normal, typical deflation, which is when asset prices revert from going up too much, is when asset prices go back down. So this is a really much of another book I just enjoyed reading was called The Capitalism About Capital, all about how the world is really shifting to intangible assets, i.e. equities, versus tangible assets, i.e. Mostly gold and commodities. And those intangible assets going up at the pace we are right now. Number one, the stock market is an inflating asset, it creates wealth effect. And that's why I tilt back to what we said earlier. It's right now becoming its own worst enemy because the market went up. Okay, the Fed's going to ease. We're not going into recession, soft landing. It's all completely assumed. Now we're starting to realize, okay, well, the Feds can't ease if the stock market keeps going up because it's creating inflation, which means it might be worse when they eventually have to. So that's where we are now.
Rock and a hard place.
Exactly. It's between a rock and a hard place. I mean, it's wonderful that it's basically North America, most notably American exceptionalism, but how much longer that can last. So I look at the S&P 500 versus the MSCI ex-US index, the highest ever. You can go back to almost 50 years on that. It looks just like the U.S. stock market did in the up to the peak in 1929. So I don't like to focus on that too much, but I have to focus on what's the overwhelming force in markets that matter for commodities. And the macro right now is overwhelming, i.e. what's happening with China tilting towards Russia and this massive pump in equity prices. And then the Fed. So here's a key thing I like to point out is typically you don't get a bottom in commodities after a cycle like this until you have a decent lag to central bank easing. There's only one bank that's really significance that started easing, that's China. But all the rest of the banks, they haven't started, and they shouldn't, and they can't because they're being delayed by this rapid rally in the equity market because we've priced for we've priced for, I guess, a very good economic situation. So my tilt for this year is that pendulum at this time, beginning of the year last year, was the S&P 500 was at about a 20% discount from its high, and everybody said we're going to have a recession. I was wrong. I agreed with that. Now we're at the all-time highs. We've swung so far the other way that it's going to be a soft landing. Economy is going to be fine. The Fed's going to ease. That the risk this year is by the time we sit down next year is we just swing back a little bit. And I'll end with this. Today is February 22nd. 23rd. Got it. Yes, exactly. Yeah, 23rd. And as of now, the total return on the S&P 500 for this year is about 7%. So you can just say it's been a good year already, and it's only not even 2 full months into it.
It has been. Now there's an American election coming up.
Oh boy.
Does the Fed continue on their course, or do they start easing going into the election?
Profiles encouraged from Mr. Powell. When Mr. Trump pushed back on him really hard for easing, I think it was 2018, Mr. Powell refused to resign and push back. So I have to respect what he did back then. I think it really helped solidify the value of the system, the dollar, and Mr. Powell. So I think Mr. Powell could care less about the election. I know people put it political, but right now I think he's seeing what I'm seeing is inflation's above target, and there's a massive speculative frenzy in the equity markets. That is not an environment to even consider easing. But he has to say things to prevent volatility. You don't even consider easing in that environment if history is a guide. It's just silly because you pump. You don't want to add fuel. You don't want to add alcohol to the punch bowl when the party's breaking out. You're supposed to remove it. And right now, the party in speculative frenzy, speculative risk assets in the U.S. particularly is just rocking. That's an environment to tighten, actually.
So the dot plots are planning for 3 rate cuts this year. You don't see those rate cuts happening.
Only if the stock market makes it. So look at at the end of last year to Fed fund futures for this year were priced for about 170 basis points of cuts. It was seriously silly, but we can blame Mr. Powell for that. He shouldn't have made those comments that were very tilting towards easing. Now they're priced as we speak at the 23rd of February, priced about 90 basis points of easing, which is still too much, I think. And I look at it this way: is there is no reason to ease at all with the stock market in the midst of a pretty serious speculative frenzy. Like I said, 7% up, and just not even for first 2 months of the year at the all-time record highs is not an environment. In fact, actually, typically that's an environment you tighten if you're a responsible central bank.
Now we've focused mainly on the gold market. silver has not been following gold. Has it become so much an industrial metal now that it should no longer be tied to the gold?
Yeah, to me, you answered your question. It's no longer tied. I mean, Sir Isaac Newton, decided when he ran the mint in UK and was at the 1600s, went for gold, and it's been demonetized since. And the fact is, the deepest pockets on the planet, central banks are buying gold. They're not buying silver. Silver is an industrial metal. And I think it's much more linked to copper nowadays. And I see copper, the dollar price of copper, more likely to drop towards 3. And it's what was resistance around 5 seems to be pushing lower, ebbing towards 4. So that's the way I look at silver. Silver stuck between 21 and 26. I don't see it really breaking out significantly, particularly with gold rallying, but it's at much higher risk of doing what copper does, because it is now really much more of an industrial metal. And bottom line is, we have to let people know is central banks, deepest pockets on the planet, can print money and are buying gold at the greatest pace in history, according to the World Gold Council. They're not buying silver.
Okay. I've often postulated that as we do head into recession, and we're overdue, that, I know everyone says this time it's going to be different, but I actually believe this time it may be different. And the reason that I believe that is that historically governments, when faced with recessionary pressures, try to get their population back to work as quick as possible. And, that's where you always had blacktop politics, where they, build roads and such.
Yeah.
I think why I think it'll be different this time is that the need for infrastructure requires a lot of technical things. It's electrical infrastructure, it's internet infrastructure, it's the green economy, and all of this is going to require industrial metals to be able to do that. So are the industrial metals working on muscle memory and heading down in anticipation of a recession, when in reality, if I'm correct, and this time is different, they should remain higher? That's the question.
I fully expect copper and industrial metals to continue outperforming crude oil. The US and Canada together have an excess of liquid fuel supply, including crude oil and ethanol and other biofuels, of about 6 million barrels a day. That's a problem for prices. It's wonderful for what we have and what we've created just by human ingenuity. But the key thing about industrial metals and copper is the number one factor is China in decline. Okay, that's a problem. We have the number one indicator might be to see that saying the stock market in China is pick up. But the point you've made is clear, but it's been what people have been pointing out for a while. But it's part of the reason copper did make an all-time high in 2022 on that big pump, and crude oil didn't. So, but I still think copper and industrial metals are more likely to outperform. I see copper bottoming around 3 and maybe getting to 3. And once it can just show some strength above 4, there's your indication of more recovery. I think crude oil is more likely to go to 40. It's not really profound based on the pendulum swinging in a normal commodity cycle. The big issue right now for number one for all commodities, with the exception of gold, is we are in the wrong stage of the high price cure. Something I learned from my farming background. Farmers use it all the time. Sure. Farmers in Canada get it very well, is once you get those prices pumped up, you create more supply, and on a global basis, they're just pressuring those elastic commodities. Now, industrial metals are least elastic, but that is the key. We're on the wrong side for all commodities of that high price cure. Now we're heading towards, got to get to the low price cure. One major commodity has gotten there, natural gas. We're finally seeing the price of natural gas, the number one measure of heat, electricity, and fertilizer in both of our countries, is at the lowest price since it was first traded in April 1990. Imagine that's 34 years, right?
Yeah.
So that's a good leading indicator. It's the highest volatility major commodity. Industrial metals are following it. Grains are right there. They haven't gotten dropped below the cost of production yet in corn and soybeans, but getting there fast, but typically have to shut off that supply and make prices rebound. And industrial metals are all in the wrong cycle. There's also the wrong cycle they're on the stage of too, and that is easing, central bank easing. Typically, we haven't even started aggressive easing. Once that starts, then you can start looking for bottoms. But if the last 2 major shifts to easing in 2001 and 2007 are a guide, you got to wait almost at least a year. for those to bottom. And then there's that issue with what's happening in China. So I look at it, this is a wrong cycle. And I think most commodity traders are astute enough, they're just looking for rallies to sell. So what I did recently is I point out in the grains, corn, soybeans, and wheat, managed money net positions, hedge funds are the most short ever. Like 20% of open interest is short, right near the lows of that big flush we had in 2019. I think a lot of those shorts are tilting over to crude oil because there's your opportunity. It's got geopolitical risks supporting it. And they're not really shorting natural gas because it's already so cheap. So we all know it's a bear market. I don't know what stops it. And then we see things like strength in the US dollar, and all you need is that little tilt lower in the US stock market, which shows a tilt towards recession, and all the dominoes tumble. So right now, I think the biggest risk is we tilt towards a normal deflationary reversion from the biggest pump in liquidity ever to the peak in 2022. We've been able to delay that, but not in Europe. They're having that problem. Not in China. They're having that problem. The U.S. is the lone star at the moment. And I just, I hate to be bearish, but I like to point out facts. And,
It's I don't look at things as either bullish or bearish. I look at everything as being pragmatic. There's times when you're the bat, and then there's sometimes when you're the ball. So
Right.
that's the way we look at it. If people want to follow your work and follow your advice, how would they do so?
I'm on Twitter at Mike McGlone 11, and LinkedIn, Mike McGlone, Senior Commodity Strategist, Bloomberg Intelligence, and definitely on a Bloomberg terminal if they have Bloomberg terminals. And then, reach out to me on any of those venues. And if you want to be added to my distribution list, I'm happy to add people. Doesn't cost anything because you get it later. After people in the Bloomberg terminal are first, my employer, but I'm happy to send PDF versions to others. And I like to hear other people's views.
Wonderful. It's been a pleasure having you on finally, and I look forward to having you on a regular basis. And you provide a good pragmatic view of the economy and the commodity markets. Thanks very much for joining me, Mike.
Thank you for having me.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.